back. I mean, if we see, we calculated this unrealized profit on your closing inventory. If it's we did it somewhere up on the calculation. Let's go back and see. The unrealized profit was 600. So we put it here, this unrealized profit, and this is going to actually decrease your retained earnings. So you should be subtracting it, because what happened, that parent has sold these goods to subsidiary, and the parent retained earnings actually include this profit because the parent has sold. But for the group, you cannot recognize it. So when you are calculating group retained earnings, so this parent retained earning 36,000, it actually includes this one. So you have to subtract it from the group. I mean, I explained this before. But then you should pay attention that there is one more unrealized profit. Okay, there are two, because if you remember, there was one adjustment in which it said that on 28th March, Dutch company dispatched goods to Latry with a selling price of 700,000. These were not received by Latry company until after the year end. So it means that they were not reflected in the inventory, but they should be considered as the inventory because this is goods in transit. You call them goods in transit. And the parent, when they dispatched it, they invoiced it, they included that. So whatever profit was within these goods in transit, it is already included in 36,000. And these goods have not been sold by the subsidiary. I mean, they have not yet received. So they are still in the group. So these goods in transit are still within the group. So you should subtract that also. This is one trick in this question. You should say unrealized profits on goods in transit. And the value of the good was 700,000. And just like we did before, because they charge markup, we should say 700,000 multiplied by 40 divided by 140. This is when you have to calculate the markup. If they say 40% margin, then you should straight multiply 700,000 multiplied by 40%. That is when they do margin. Margin, you remember that margin is on the sales price, but markup is on the cost price. So 700,000 multiplied by 40 divided by 40 by 140. So, and I should be actually dividing it with, I should not be including these 3 zeros because we are ignoring 3 zeros in our calculation. So let me ignore here also because we are putting 3 zeros on the top. And this should also be multiplied with -1 so that it gives the effect. So this unrealized profit should also be subtracted. Now, one more thing, and I think probably this is the last thing, the last adjustment which we did not read. It was adjustment number 4. It says that the investment in American company represents 30% of its voting share capital, and Dargent company uses equity accounting to account for this investment. So they actually, when you go back to their balance sheet, you see that the parent company balance sheet, there is one investment. There's an investment in American company at 1st April 2005, note number 4. It was 4,500 in their books. So they made some investment. So it's not a subsidiary because it is, it is not more than 50%. It is less than that. It is 30%. So it's kind of associates profit. Share capital, and Dargent company uses equity accounting. Equity accounting, if you remember, there is IS 28. We use it for when we do accounting for associates. American company's profit for the year ended 31st March 2006 was $6 million. And you should remember that they are 30% shareholder. I mean, the parent is 30% shareholder in 6 million. And American company paid total dividends during the year ended 31st March of 2 million. So out of this 6 million, 2 million has already been paid as dividends. So out of 2 million, probably 30%, which is like 600,000, already has been paid. I mean, and probably received by February. Dargent company has recorded its share of the dividend received from American company in investment income and cash. So whatever you see the cash here in the parent, let me see whether it's the bank or cash, this 1.2 million. They already have received this income and they have showed it in their assets. Okay. So their total retained earnings were 6 million for the year. 2 million has been paid out. So what is remaining? 4 million. Out of 4 million, 30% should go to the parent. And we should say that, share in Ameri's retained earnings. What is their share in their retained earnings? So you should calculate it like 4 million, which I would put it like this, 400,000, 400 multiplied by 30%. This is their share. Because there was total retained earnings 6 million, 2 million has been given out. What is remaining is 4 million. From 4 million, you are taking 30%, and this should be, and actually it's not, it should be 4 million. So with 3 zeros, we should be doing it. It's with millions. It's not 400,000. It is not this. It is 4 million. And this should be a positive number. So I think that's all. There's nothing else. And then you make a total, and it comes out to be 37,390. And this is what you call as group retained earnings. Group retained earnings at reporting date. So this number also we are going to take to the balance sheet. So now what we did, let's go back and recall. We calculated our goodwill. It is done. Goodwill was 11,000. We use this number in our balance sheet. We need it. Then there is an unrealized profit of 600,000 on your closing inventory, but there is also an unrealized profit of 200,000. Then NCI at reporting date is 9430. This we will use in the balance sheet. Then this we don't need this in the balance sheet because we used it. We already have distributed the profits. This 1720, some part 25% we have given it to the non-controlling interest, and 75% we have given it to the parent. So we actually are not going to use it in the balance sheet. We just needed to divide it, and we already have done that. And then we found out our group retained earnings at the reporting date. So it looks like that now we are ready to just fill up our balance sheet pro forma. So what I would do, I would just drag it down so that we can see the numbers while we are making our financials. Let's drop it down a little bit more, and we make some space. Okay, there is something more on the top. So that was a long question. Okay, let's bring it down so that we see the numbers in front when we are working. So here we go. Now we are ready. We should be saying that when you prepare your balance sheet, you have to put the title, and you should say, Dargent Company Consolidated Statement of Financial Position, and as at 31st of March, or 31st of December, or March, 31st of March 2006. So this should be your title. And you remember that first thing is assets. And within assets, you first define your non-current assets. You will write down here non-current assets. Then we will have our current assets. And finally, we will have our total assets. And we know that our current assets are sum total of these numbers. So we start with what is the first line. You should write down here property, plant, and equipment. So property, plant, and equipment. And how much is that? So you should see that the parent number for property, plant, and equipment is 75,200. 75,200. Then you have got for the subsidiary, it is 31,500. So far it looks like this, but there is some adjustment which you need to make. And if you remember that there was a mine which as an asset which we recognize. You remember when we said that they did not create provision? So we said they will recognize the asset, they will recognize the provision. So it was done somewhere here when you were doing the fair value adjustment. If you go up, we said fair value of asset 4 million and present value of provision. So this 4 million we have to add into the assets. So we add this into asset, but then we have to subtract the depreciation. If you remember 2 months depreciation, we subtracted from here. This was depreciation of mine to 200,000. So you add 4 million and you subtract 200. So addition of asset and minus the depreciation, so net book value. Now this comes here and you put an equals to sign. So you've got here 110, 500. This is how you will do your assets. Then straight away you go to your goodwill, and goodwill you calculated above. I don't know, it was note 1 or note 2, you should mention here. And I could go up and find out our goodwill, which was 11 million. So we add 11 million here for the goodwill. And then you have got your investment in associate. The third thing is investment in associate. We don't forget about it. Investment in associate. And how do you do investment in associate? Now, if you see that your opening balance was 4,500, plus when you see that here, you made the share in investment in associate, this 1,200. This was your share for the year, okay? I mean, 4 million was retained earning during the year, and 30% of that. So opening balance was 4.5 million plus 1,200 you should add. So your closing investment, I would call it my closing investment. So my opening investment was 4.5 plus my share in the retained earnings during the year, and it is 5.7, and you make a total of that. So these are your, you can call them as your non-current assets. This number we will highlight, we need this number. Then comes your current assets. And within current assets, what you have, again, if you see, the first thing is inventories. And for inventories, you need to be careful. You have to pick up the inventory, which is the parent inventory plus subsidiary inventory, which means 19,400, plus you've got 18,800. And plus you have to see 700 you have to add. What is the 700? This 700 was goods in transit, because when parent dispatched these goods, they subtracted from their balance sheet. So 19,400 is the parent inventory after deducting 700. So parent dispatched, parent subtracted. But subsidiary has not received. So subsidiary has not added it. It is in the transit process. I mean, if subsidiary had received it, they would have said 18,800 plus 700. Subsidiary did not receive. So it is subtracted from parent balance sheet, but not added in the subsidiary balance sheet. So you add it here. And minus the unrealized profit, because inventories, we know that inventory in the group balance sheet should be shown at the cost to the group. So whatever is the unrealized profit, that should be subtracted. So you have two unrealized profit, okay? One was 600, that was the unrealized profit on the closing inventory, and one was 200. If you remember, we made these adjustments in group retained earnings. This minus 600 minus 200. Both of them I should subtract. So we put it here, and this is your group inventory. By the way, let me tell you the double entry for this closing inventory unrealized profit adjustment. Whatever is the unrealized profit, you say, debit group retained earnings. This is your double entry for this unrealized profit adjustment, and you say credit group inventory. And in our case, it should be 800, like 600 plus 200 here. So you should be reducing the group retained earning with 800, and you should be reducing the group inventory by 800. Okay, so this is the double entry for group retained earning, and the unrealized profit. You see, we are reducing the profit, and we are reducing the inventory value. So this is how it should be done. So group inventories are done. Then you have got trade receivables. And within trade receivables, parent receivables are 14,700 plus subsidiary receivables are 12,500. And if there is any intra-group receivable, that should be subtracted. So do we have intra-group receivable? I think yes, we do. There was something given. It said that there was some adjustment here. I remember I saw it. Yeah, here it goes. It says at 31st March 2006, Dargent Company's record showed a receivable due from Lottery of 3 million. This differed to the equivalent payable in Lottery Company's record due to the goods in transit. Okay, so there was some difference in payable because one company received, one did not pay, but there was 3 million in receivable. So you should be subtracting it. So I would say 14,700 plus 12,500 and minus 3 million. So when I take it here, minus 3 million, and we put it here, and we put the equals to sign. So you've got 24,200, and then you have cash, and cash or bank. They didn't use the word cash; they used the word bank. So let's use the same word. It is 1,200 plus 600, and that makes it 1,800. So here you go with your current assets, which is 65,300, and just make a line and we highlight it. So it is 19,400, 20, 38,100, and okay, there were two minus signs. Let me see if the numbers. So 30. So this is 64,100. So these are your current assets. And if you see total assets, just make a total of that, and that's done. You make a total of this plus this. So this line is your total assets, which are 191,300. Let's make it bold and let's put it like this. We need this number. This is our asset side of the balance sheet is done. Then you have to make equity and liabilities, the other side of the balance sheet. And first, when you make equity and liabilities, the first section is of course always equity. You put equity, and equity you start with the share capital, and you call it share capital. Now you should remember that the share capital, whenever you do consolidation, you only show the share capital of the parent company. Subsidiary company share capital is never shown. So what is the parent company share capital? That is 50. This is 50 million. Okay, this is what you need to show. But while doing it, you should remember that they issued some share to make this acquisition. And if I'm not mistaken, we made it up on the top, this calculation. We said that when they acquired the subsidiary, they issued some shares worth 32 million, out of which we said that 10 million will be shown in share capital, 22 will be shown in share premium. And why we are going to add it? Because in the question they told us that this company did not show it before, because it says that in the top it said that none of the purchase consideration, not the outstanding interest on the loan notes at 31st March has yet been recorded by Dargent Company. So Dargent Company has not shown this share capital in their balance sheet. And also they issued loan notes. Those loan notes they also did not show. And by the way, I just now feel that probably we made a mistake in the retained earnings, because there is some interest which also we should be subtracting. I think this group retained earning, this line, we need to subtract the interest, because they when they purchased the company, they gave the loan notes, and there is 8% interest on that, and that 8% interest is paid by the parent. Okay, so we need to decrease that, so that interest cost we did not consider. So if we include that interest cost, your group retained earning should decrease. So I think that we should be making that adjustment here. I just now realized we should say that interest on issued bonds. So thank God that we just found it in time. So what was the value of bonds which we issued? So we issued bonds worth of, in our consideration, we gave bonds, loan notes. You remember that loan notes of 15 million. So whatever are the loan notes, we should be calculating, the interest on that. And it is 15 million and it should be 8%. So we should be saying that 15 million multiplied by 8% and multiplied by 3 by 12, because it is only 3 months period, just like we did in other cases. And we put here equals to sign, and you multiply it with -1 because it is going to decrease your number. So this actually should be the number 36,390. It's good that we found out in time, otherwise the balance sheet would not become equal. So share capital. So the share capital as per balance sheet is 50 million, and you have to add up this share capital. So you issue share 32, but the value of shares is 32, in which face value is 10 million. This goes to capital. 22 million will go to share premium. So we will add this 10 million into 50 million. We'll say 50 million plus 10 million. So it makes us the number as 60 million here. Immediately you should write down at the bottom as share premium, and we know that share premium was 22 million. So this is done. What else was in the balance sheet on the equity side? Okay. So I think these are the only things. We've got only 2 items in the equity. There is no other reserves or stuff like that. So let's have a look at that. Share premium we have done. Then we do retained earnings, and here we should write down the group retained earning. Okay, that one, not the NCI part. The group retained earning. That 37 thing which we calculated here. This 3739. This we should be adding up. So we add up this 37 also, and we make a total of that now. When you make a total and you come up to a number 119,390, and what do you call it actually? You should give it a name. You should say that equity attributable to the parent. Okay, this is the proper name, equity attributable to the parent. So this is the equity which belongs to the parent, because that is what is 75%. And then you should say non-controlling interest at reporting date. This should also be added. This is also in the group. So how much was the NCI in the group? NCI at the reporting date we calculated before. So please do not forget that within the balance sheet you have to write down this is the equity which belongs to the parent, and this is the thing which belongs to the NCI. So this also must be shown. And after you do that, so this is your total equity part. If you want to make a total, you can make total, or you can leave it like this. I would prefer make a total. And let me make that space, and this is, so I'll call it like this. So this is 128, and I'll call it total equity. So within the total equity, some part belongs to the parent, some part belongs to the subsidiary, and this is one number. If you have to see what is equity, it is 128,820. And by the way, it will be good if we could just format these numbers. I would prefer to format them like this. I'll make them space, and then I'll remove them so that we have numbers written clearly. Then you have non-current liabilities. Usually this is your format, non-current liabilities, and you make it IU. And what are the non-current liabilities here? It says 8% loan notes, 5 million. Now you should remember that this 5 million, 8%, this is some other loan notes. This has got nothing to do with the loan notes which we issued at the as consideration. You remember this consideration, you issued loan notes. Loan notes. When you acquired the company, you offered the loan notes as consideration. And these loan notes were not included because it is given in the question. None of the purchase consideration nor the outstanding interest on the loan notes has yet been recorded. So you have to record now. So you should say loan notes. And within loan notes, there will be 2 values. One, this 5 million, which is given on the balance sheet, plus this 15 million, which you gave as consideration, but you did not record. So you record that also. So you show a total loan note balance of 20 million. This is your long-term liability, non-current liability. And then you have your other things, like you have got your provision, which is also a long-term thing. And that provision was 4 million, if you remember. It was 4 million. And the interest on that provision, which you should be calculating. So how much was the interest? Their discount rate was, where did they show in the question the discount rate? Let me show the calculation of provision. 4 million, and the interest discount rate is 8%. So provision long-term 4 million, and you should be adding up interest on that. So I would say 4 million multiplied by 1.08. So if you see like this, it will give you a number 4320, but you should do it with 3 divided by 12. So let me just remove it, and I'll put it like this. So 4 million, and I would say 4 million plus, so this was the total value of provision. 4 million was the provision, and plus the 3 months interest rate. So together your balance should be 5080. Interest value 4 million into, I think 4 million into 8%, and that is by 3 by 12, 8% if you calculate. Okay, let's move forward. And then you have accrued interest on the loan notes. So this interest on notes, this is actually your current liability. You will put it this accrued interest. Remember when we subtracted this 300,000 from here in interest on the loan notes, when you issued this bonds of 15 million, they were on interest. Okay, and in the question they told us this bonds they issued 15 million, and they were on some interest. What was the interest? They told you that interest is 8%, and then they say nothing was recorded, not the outstanding interest. So this interest was our cost. We subtracted it from our retained earning. From group retained earning, this 300, we subtracted this interest, but because we have not paid it yet, so it should be added into our liability. So this also goes into as your liability. So accrued interest on the loan notes, we have done that thing. It is done. Let's just create one space, and then comes the last thing. So this loan notes is done from the balance sheet. Then comes the current liabilities. Now current liabilities, you have to be a little bit careful because there is some trick in that. Usually what you do, current liabilities, what you have, you just make 24,000 parent liability plus the subsidiary liability minus any intragroup receivable or payable. So how much is your intragroup receivable? If you remember that when we were making our current assets trade receivable, we said parent receivable plus subsidiary receivable minus this 3 million intragroup receivable. So this 3 million was shown receivable in the parent's book, and this 3 million should be shown in the subsidiary liabilities. So you should subtract 3 million from here, and you should subtract 3 million from here. This is the usual condition. But there is one more adjustment which you need to do in this question, and that is plus 700. That plus 700 is what? There were some goods in transit, 700, for which we calculated unrealized profit also. If you remember, there were 700,000 goods in transit, which is given in this question, this 700,000, which the subsidiary has not received. So actually, it should be like this, that the subsidiary balance is 16,400, but subsidiary did not receive the goods, and it was not showing that payable balance because it has not received the good. It has not recorded the invoice. So when they receive the good, they will increase their payable with 700. and then minus 3 million, because parents has sent the book. In parent receivable of this 3 million, the 700 was included, but subsidiary was not showing it as a liability. So first I increase the subsidiary liability, like 16,400, plus the liability of these goods, which it has not booked, minus the 3 million, the intra-group. Now it should be a correct answer. When you make like this and you put equals to, this comes to you as current liabilities. Now when you make, now you've got an equity, so you've got liabilities. I make a total of this. And actually you don't make a total of all of the liabilities, because some of them are current, some of them are non-current. And I would actually call this one. So this is actually my non-current. This I would call as my current liabilities. So current liabilities are is this section. And if you want, you can make a total of these two now. Now this is a total of non-current liability. This is the total of your current liability. And now this number, and plus this number. Three numbers you should be adding up. And you should say total equity and liabilities is both. And you put it here 128,820 plus 25,020 plus 38,400. And it comes out to be 192,300. This should be equal to the total asset thing. Now if you see what were the total assets, here I see some difference. Okay, I see some difference. I just noticed. We've got here 191,300 on total assets and 192,300 on the total liabilities and equity. So balance sheet is not becoming equal. It looks like there is a 1,000 difference. 1,000 difference, which is actually not 1,000, which is 1 million. Let me see what we did. Loan notes were correct. Provision, 4 million plus 4 million up here. It was 4 million into just 0.08, or you can call it 4 million into 8%. Okay, 8% was the interest. Your interest was 4 million into 8% into 3 by 12. This should be the formula. If I put it here and I put equals to sign, now it becomes equal 191. You see, we just made a mistake here. So you should, what I'm doing, my 4 million was opening provision at the beginning of the year on 1st January. Then 3 months interest you have to accrue, because this provision is unbinding. If you remember the concept of present value is 4 million, you have to unwind, you have to add the interest. We did this thing in provision standard, that you have to unwind the provision, add it to make it the bigger value, inflated value, so that you pay the maximum amount in the future. And it should be 3 months interest at 8%. So your balance sheet is equal. So usually when you are doing it in exam, it is possible that sometimes some numbers are not equal. You should not be worried. I mean, don't waste your time on making the balance sheet equal, because in balance sheet calculation, they start giving you numbers on these workings. When you show your workings, you should show them very clearly. So there are marks which are allocated to these workings. And when you start filling in the balance sheet, of course, you will get marks here, you get mark here, you get mark for these things, you get mark. So if there is one calculation which you made mistake, just like we made a mistake here, so probably they will deduct 1 mark out of that. But rest of the marks you will get. So when you are in exam and you see that probably there is some small difference, you should not be spending too much time on that. If you can find it out easily, do it. But if it looks like that it is taking more time, just leave it and move on, because it doesn't worth it that for just 1 mark you spend 10 minutes. I mean, 1 mark you cannot spend 10 minutes. So this is one long question. You should be doing 2, 3, 4 long questions before you go to exam. And I would rather suggest that do 1 question twice, because when you do a question for the first time, you are kind of not 100% clear on that. Okay, but when you do it for the second time, you become more confident and you know exactly what you are doing and why you are doing. First time it is just like you are learning, but the second time you are doing. So I suggest that, I mean, if I were you and I have to prepare 10 questions, I mean, I have time for doing 10 questions. So I have 2 options. Either I do 10 questions 1 time, or I do 5 questions 2 times. Believe you me, I would do 5 questions 2 times, so that whatever I do, it becomes clear to me. So that's all with this question. We'll do 1 more question together.